Hello, and in this mini lecture we're going to look at macro and microeconomic reform. What are they? So let's have a quick look. Quite simply, macroeconomics deals with the behavior of the economy as a whole. Microeconomics, in contrast, deals with the decisions made at the micro level, made by individuals and businesses regarding the allocation of resources and prices for various goods and services. So one is the big picture, macro, about the whole country, the whole country, and micro is about people and organizations. So macroeconomics is part of an economic study which analyzes the economy as a whole, big picture. It's the average of the entire economy and does not study an individual unit or a firm. So it's an average of everything in the things it looks at, not just a specific industry. It studies various key economic indicators of the economy. Generally, it is 6 key indicators, as we'll see. So the majority of the literature suggests that the level of economic activity can be viewed by looking at 6 key economic variables or indicators. The 6 variables together provide a significant viewpoint about the macroeconomy. The 6 variables are the gross domestic product, and you'd hear that in the news sometimes in the evening. Gross domestic product is going up, going down, stagnating, so on. Unemployment rate, definitely in the news, whether it's going up or down and so on, or stable unemployment rate. Inflation, whether the price of things is going up or not. Interest rate, what we pay on our loans. Level of the stock market, is the stock market going up, going down, what's it doing? And finally, the exchange rate. So the gross domestic product measures how well the economy produces goods and services that people find useful. So it's often divided by the number of workers in the economy. So it's for this one, it's gross domestic product per capita, per person. Does not indicate the relative distribution of the nation's economic product. So it's not about that. It's not about looking at individuals or people or segments. It's just the big picture. Over time, economies tend to move through periods of peak and trough. It goes up and down. Certainly in my life, there have been periods of economic growth, periods where it's gone down, stagnation and so on. That's just the way things work. Unemployment rate equal to the number of unemployed people divided by the total labor force itself. So it gives a percentage rate. An economy with no unemployment would not be a good economy, as strange as that might seem. In order to function smoothly, an economy needs jobs looking for workers, vacancies, and workers looking for jobs, the unemployed. So generally, it's accepted that a rate of unemployment is needed. So it's like the oil of the wheels keep turning. So it's about there needs to be vacancies for people to look for, and vice versa. So that generally it's accepted that an unemployment rate, albeit not too high, is acceptable and is better for everybody. Inflation rate, the measure of how fast the overall price level is rising. So if the inflation rate this year is 5%, that means things this year in general, on average, cost 5% more in money terms than last year. So if you bought something for $100 last year, it would be $105 this year in general. The interest rate, important because it governs the redistribution of purchasing power across time. So when interest rates are low, like they are here now in 2020, money's cheap. Investment tends to be high because businesses find that even less profitable investments will still generate the cash flow needed to pay the interest and repay the principal borrowed and still make a profit. Level of the stock market, an index of expectations for the future. So a high value, rising prices called a bull market means that investors expect economic growth to be rapid, profits to be high, unemployment to be low, times are good. When the stock market is low, falling prices, a bear market. Average opinion expects the economic future to be relatively gloomy. We're going through a period where things are not so good. Exchange rate governs the terms under which international trade and investment take place. If domestic currency appreciates, its value compared to other currencies increases. So foreign produced goods are relatively cheap for domestic buyers. Imports are likely to be high because the imported goods are cheaper because our currency is appreciated. Domestic made goods are relatively expensive for foreigners. Exports are likely to be low because our goods are too expensive or more expensive. In contrast, microeconomics is a branch of economics that studies the behavior of individuals and firms in making decisions regarding the allocation of scarce resources and the interactions among the individuals and firms. So microeconomic theory states that supply and demand get balanced by market forces at a specific price, the equilibrium. Remember back into lectures 1 and 2, supply and demand, market equilibrium is what we were looking at in those lectures. If the demand goes up, the price also goes up. This has the effect of restraining the growth in demand. As a result, demand and supply reach a new balance or equilibrium at a higher price. Demand has gone up. People want this good and they're prepared to pay for it. Demand has gone up, supply has gone up, but the price has also gone up as well. Microeconomics in healthcare. Microeconomics within healthcare is about the allocation of resources. So decisions about how to allocate doctors, nurses, labor, whether to build a new hospital, whether to pass a new law, how much research to put in for a new drug. And once the research has been completed, decisions about how to price the drug are made. These decisions are made almost solely based on questions related to economic principles. Where will labor be most effective? What is the best outcome for our resources? How can we find the most cost-effective materials for the hospital? What we're going to build it from? How much did it cost to develop this drug? What kind of long-term returns can we expect from it? These are all microeconomic type terms. Is healthcare a macro or a microeconomic issue? It's a micro issue. It's a very large area to cover, but has nothing to do with the economy. It's not one of those 6 factors. Private and public healthcare is a business, not an economic issue. Even though our economy affects the healthcare industry greatly, it's still a micro issue. Healthcare is not a macro issue. So in conclusion, macroeconomics deals with the behavior of the economy as a whole. Can be viewed as looking at 6 key economic variables: the gross domestic product, the unemployment rate, inflation rate, interest rate, the level of the stock market, is it going up or going down? The exchange rate, is it going up or going down? Microeconomics, on the other hand, studies the behavior of individuals and firms in making decisions regarding the allocation of scarce resources, the way we do business, the way we might change things, and the interactions amongst these things. So micro, very much the smaller thing; macro, the big picture of the whole economy. Thank you.